Panic on the trading floor. In the worst crash it has seen in decades, the Indonesian stock market just had $80 billion in value completely wiped out. But this wasn't some random market blip. This was different. So what really happened? The fuse was lit by a stunning warning from the global index giant MSCI. Think of them as the gatekeepers for big money. Their emerging market label is a green light for global funds to pour in billions. But MSCI hit pause, flagging major concerns about a lack of transparency and the risk of coordinated trading that was warping prices. They warned if things didn't improve by May, they might downgrade Indonesia to a frontier market. That single threat was enough to send investors running for the exits, knowing the downgrade would force a massive multi-billion-dollar sell-off. MSCI's warning was like throwing gasoline on an already smoldering fire. Investors were already on edge about government turmoil, populist spending, and nepotism concerns after the president nominated his nephew to a top post at the central bank. The fallout from the crash was swift and brutal. In a stunning move, the heads of both the stock exchange and the Financial Services Authority resigned, calling it a matter of moral responsibility. Now regulators are in full-on damage control. They're scrambling to rush through reforms, promising to increase transparency and to double free float requirements for listed companies, which would make stocks a lot harder to manipulate. But here's the $80 billion question. Will any of this be enough to restore confidence? Let me know what you think in the comments.